The Psychology of Investing. Chapter 4. The Pitfalls of Panic Selling. Selling at a loss feels hard because it rarely feels like a simple numbers decision. For many investors, the moment they consider selling below what they paid, it feels personal, almost like the market is confirming that they were wrong. That emotional sting is powerful because losses tend to hurt more than equal gains feel rewarding. A portfolio decline can create a sense of threat, even when nothing immediate has changed in your daily life.
As a result, people often delay action, not because they have done a careful analysis, but because the emotional discomfort is so strong. Understanding that reaction is important, because the pain itself can start driving the decision. This is where loss aversion comes in. Psychologically, a $30 loss often feels far worse than a $30 gain feels good. Even though the amounts are identical, that imbalance helps explain why investors may hold on to losing positions longer than they should. Inaction can start to feel safer than action, because selling forces you to experience the loss directly. But avoiding that feeling is not the same as protecting your money. An investment does not become safer just because you postpone the decision. The key lesson is that emotional comfort and financial wisdom are not always the same thing. A helpful distinction here is the difference between an unrealized loss and a realized loss. If you bought at $100 and the investment falls to $70, the economic loss already exists while you still own it. Selling at 70 changes the label from unrealized to realized, but it does not suddenly make the investment worth less than it already was. Your cost basis matters for record keeping, but the market value is what you actually have today. Many investors feel as if the sale itself creates the damage, when in fact the damage occurred during the decline. That misunderstanding can keep people frozen in weak positions. Clear thinking starts when you separate the emotional meaning of the sale from the economic reality of the loss. Part of the resistance to selling comes from the way the brain processes loss. Research suggests that financial losses can trigger stress responses, similar to other forms of pain. So the experience is not just abstract. When prices fall, the brain can treat the situation like a threat that needs to be escaped or avoided. In that state, hope becomes very attractive. Telling yourself that the investment might bounce back can feel calming, even if the evidence is weak. The problem is that this comfort can overpower clear judgment. When emotions become intense, the most emotionally soothing choice can start to look like the most rational one. This is how the trap forms. You buy at a certain price, the market falls below it, and then you face an uncomfortable fork in the road. Selling means accepting the pain immediately, while holding lets you delay that feeling. Delaying can feel like relief, which is why the choice is so tempting. But holding is only sensible if the investment still deserves a place in your portfolio going forward. If the real reason you are holding is just to avoid discomfort, risk may quietly keep building while you wait. The trap is not simply holding after a decline. The trap is holding mainly because selling feels bad. Avoiding a decision does not stop the market from moving. If a declining investment keeps falling, a manageable loss can turn into a much larger one, while you are still hoping to feel better about selling later. That is why emotional delay can be expensive. People often describe this as being patient, but patience and denial are not the same. Patience is staying with a sound investment through normal volatility. Denial is refusing to act because action would be painful. The longer this goes on, the harder selling may feel, because the growing loss creates even more regret. In many cases, the cost of delay is not just emotional strain, but real financial damage. Mia's example makes this concrete. She buys 10 shares at $50, investing $500 in total. When the stock falls to $35, her position is worth $350, and she is down $150. At that point, she avoids selling because she hopes a rebound will save her from the pain of locking in the loss. But the stock keeps falling to $20, and when she finally sells, she receives only $200.
What began as a $150 setback becomes a $300 realized loss, largely because the earlier decision was driven by discomfort rather than analysis.
The better question is not, does selling feel bad? Of course it does. The better question is whether the remaining money is still in the best place. When Mia's investment fell to $35, she still had $350 of capital to allocate. The earlier loss was already there, whether she sold or not. So the decision should have been about future prospects. Is this investment still attractive from this point forward, and does it still fit her plan? That forward-looking question is much more useful than staring backward at the purchase price. Several common mistakes make this problem worse. One is thinking it is not really a loss until you sell, which confuses emotional recognition with economic reality. Another is waiting to get back to even, as if the market somehow knows your purchase price and should return there for your sake. Investors also hold just to avoid regret, or they take excessive risks trying to win the money back quickly. On top of that, comparing your losses with someone else's gains can make the pain even sharper and push you toward bad decisions. These habits are understandable, but they can quietly turn a temporary setback into a much bigger mistake. Recognizing the pattern early is one of the best defenses. The pain of loss is real, and good investing does not require pretending otherwise. What matters is learning not to let that feeling make the decision for you. A sound choice comes from evidence, from your updated expectations about the investment, and from your broader plan. In practice, that means acknowledging the discomfort, then asking what is true today, rather than what you wish had happened yesterday. It also means judging the investment from this point forward, not from the price you paid. Discipline matters most when selling feels hardest, because that is when emotion is most likely to distort judgment. This sets up an even broader challenge. Sometimes it is not just our own emotions, but the crowd's emotions that pull us into bad decisions. When markets become uncertain, people naturally look to others for clues. In everyday life, that instinct can be useful, because copying the group often saves time and reduces risk. In investing, though, the same instinct can become dangerous. If you see friends selling, headlines warning of trouble, or apps flashing alerts, it can start to feel like the crowd knows something important.
Under stress, other people's actions begin to look like evidence. That can replace calm analysis with copycat behavior. The result is that investors may sell, not because their own reasoning changed, but because everyone else seems to be moving. Selling frenzies often begin with an ordinary decline that starts to feel like a warning. A stop drops, emotions rise, and suddenly the move no longer looks like normal volatility. Then social signals appear. Maybe a headline says investors are fleeing. A friend messages you in panic, or your phone fills with red alerts. At that point, the market move is no longer just a price change. It feels like a message. The crowd seems to know something, and selling starts to feel both urgent and safe. That emotional shift is what turns a market dip into a possible frenzy. Behind this behavior is a very common thought. They probably know something I do not. During stressful moments, we often assume that if many people are selling, their behavior must reflect hidden information. The problem is that action is not always evidence. People can sell because they are scared, because they are copying others, or because they simply cannot tolerate uncertainty. Fear makes popularity look like proof, even when the crowd has not done any deeper analysis than you have. And in markets, many people can absolutely be wrong together. So the presence of a crowd does not automatically make the crowd wise. This is how one sale can become a cascade. Perhaps one investor sells after bad news, and others notice the move. They interpret that behavior as meaningful, even if they do not know the original reason for the sale. Then they sell too, which creates a stronger signal for the next group watching. Before long, behavior itself becomes the message. This kind of chain reaction is called an information cascade, and it can spread quickly because people are reacting to each other more than to the business fundamentals. That is why prices can move sharply, even when the underlying facts have not changed nearly as much as the fear suggests. Social proof-driven selling often follows a recognizable pattern. First, there is a trigger event, such as bad news, a downgrade, or a sudden drop that creates uncertainty. Second, you see other people selling, and their actions become highly visible. Third, you join in. Not necessarily because your own analysis says you should, but because acting relieves discomfort. Finally, if the selling continues, your decision feels validated, which strengthens the habit. That last step matters because it teaches the brain that crowd following brought relief. Once you can recognize this pattern, you have a better chance of slowing down before it pulls you in. The pattern becomes habitual because selling can reduce anxiety in the moment. That emotional relief acts like a reward, even if the decision hurts your long-term returns. Over time, the brain can learn a simple association. Market stress means get out. Once that happens, you may start reacting automatically instead of evaluating calmly. The crowd then becomes a shortcut for decision-making. Rather than asking whether the investment thesis changed, you ask whether other people seem afraid. This is how disciplined investing can quietly give way to repeated crowd following. Maria's experience shows how social pressure can turn a paper loss into a realized one. She bought 100 shares at $30. When the stock fell to 24, the decline was uncomfortable, but still only a paper loss. Then forum posts, app alerts, and visible crowd fear made the situation feel more urgent. Instead of focusing on the business, Maria focused on the noise around the stock. She sold at $23.50, locking in a $650 loss. Her decision was shaped less by fresh analysis and more by the emotional authority of the crowd. The lesson from Maria's example is not that every stock eventually recovers. Some do, and some do not. The deeper lesson is that your reason for selling matters. In Maria's case, the stock later rebounded to 28, which means waiting could have reduced the damage. But the main point is not to assume recovery. It is to see that her decision came from other people's fear, rather than her own disciplined analysis. A sound sell decision should be tied to changed facts, a broken thesis, or a portfolio rule. If the crowd is the main reason, the decision deserves another look. A useful safeguard is to evaluate a drop independently before you act. Pause long enough to ask what actually caused the decline. Was it a short-term headline, a broad market move, or a genuine change in the company's long-term outlook? Then ask whether this breaks your original thesis, or whether you are mostly reacting to fear. It also helps to compare the situation with your investment plan, because your plan can anchor you when the crowd is loud. Writing down your answers is especially valuable, since it forces you to think rather than just react. Selling should be a response to changed facts, not borrowed panic. Social proof becomes especially dangerous when you do not have a clear process of your own. Without rules, it is easy to assume the crowd knows more, to monitor headlines and prices obsessively, and to confuse temporary declines with permanent damage. Investors often sell in that state, simply because there is no predefined framework to rely on.
A much better safeguard is to set sell criteria before emotions spike. That might include a broken thesis, a valuation limit, or a risk rule tied to your portfolio plan. With a process in place, the crowd has less power to make your decisions for you. And that leads naturally to the next skill, building an exit strategy before you ever need it. Another bias that keeps investors stuck is the sunk cost fallacy. A sunk cost is money that has already been spent and cannot be recovered. The mistake happens when that past cost starts controlling a decision that should depend on future value and future risk. In investing, this often appears after a position falls in price. Instead of asking what the best choice is now, investors keep thinking about what they already put in. But the market does not refund past mistakes just because you remain emotionally attached. Better decisions come from looking forward, not backward. Losing positions are hard to sell because people often feel that selling would somehow make the loss real. But as we discussed earlier, the decline has already happened before the sale. Selling does not create the loss. It only ends your exposure to whatever comes next. Holding can feel like patience, and sometimes it truly is patience if the investment still has strong prospects. But sometimes what looks like patience is really avoidance. The decision is not about protecting the purchase price. It is about what to do with the remaining capital today. One reason this bias is so powerful is that the original purchase price becomes an anchor. Once you buy at a certain number, that number can stick in your mind as if it has special meaning. If the investment falls, you may start waiting to get back to even when current facts no longer support holding. Break-even becomes an emotional target rather than a rational one. The trouble is that the market does not care what you paid. A stock is not more likely to return to your entry price simply because that would make you feel better. Good investing requires evaluating the asset on present conditions, not on a past reference point. When sunk cost thinking takes over, the decision process goes off track. The useful question, would I still want to own this today, gets replaced by emotional questions like, how do I avoid admitting I was wrong? Investors begin telling themselves comforting stories, such as waiting just a little longer to get back to their price. The old purchase price starts dominating the analysis, even if the business outlook has weakened. As losses grow, selling becomes even harder because the emotional hurdle gets bigger. Eventually, analysis is replaced by self-protection. That is how weak positions stay in a portfolio far too long. A simple way to interrupt this bias is to ask a better question. Would I buy this today at the current price? That question forces you to ignore what you paid and look at the investment as if it were new. Then you can assess the real issues, current risks, future prospects, and whether the original reasoning still holds. If you would gladly buy it today, then continuing to hold may make sense. If you would not buy it today, holding it becomes much harder to justify. This approach does not guarantee a perfect answer, but it shifts the decision back onto rational ground. It helps separate historical regret from present judgment. Raj's situation shows this clearly. He bought 100 shares of GreenTech at $40, investing $4,000. 6 months later, the stock is down to $22, leaving him with a paper loss of $1,800. Raj tells himself he will sell only if the stock gets back to 40. That sounds disciplined at first, but it is really an emotional attachment to his original purchase price. Meanwhile, the company's outlook has weakened, and better opportunities may exist elsewhere. His past entry price is quietly preventing him from making a fresh decision about today's reality. What Raj should focus on is not how to get back to 40, but whether green tech is attractive at 22. If he did not already own it, would he buy it now based on what he knows today? If the answer is no, then holding is difficult to defend. Selling would preserve the remaining $2,200 for other uses, while the $1,800 loss exists either way. That is the uncomfortable truth of sunk costs. The past loss does not disappear because you keep holding. The real choice is about the capital you still have, not the money you already lost. This mistake often hides behind habits that sound reasonable. Investors may treat a loss like a personal failure, wait to break even before acting, or average down automatically without re-evaluating the business. They may also ignore better uses for the money, because selling feels like defeat. But selling a weak position is not automatically failure. In many cases, it is discipline. The goal is not to prove that your original decision was right. The goal is to make the best decision possible from this point forward. When you feel stuck, use one reset question. Would I buy this today? That question helps strip away the emotional weight of the purchase price. If the honest answer is yes, then holding may still be justified because the investment remains attractive on current facts. If the answer is no, treat the position as if it were brand new and ask why it deserves your capital. This simple rule will not remove the pain of a loss, but it can prevent the pain from controlling the decision. And once you can think clearly about when to keep or exit a position, the next step is to define those exits in advance. Many investors spend a great deal of time deciding what to buy and very little time deciding when to sell. That imbalance can become costly because selling decisions often happen under pressure, when emotions are strongest. A pre-planned exit strategy helps by replacing in-the-moment reactions with rules set while you are calm. It gives you a way to prepare for both good outcomes and bad ones before money and emotion are on the line. Instead of improvising during a price swing, you already know the conditions that would lead you to act. That does not make investing easy, but it makes your decisions more consistent. In many cases, the biggest benefit of an exit plan is psychological stability. A pre-planned exit strategy works by setting decision points in advance. Before you invest, you define what you will do if the price rises to a certain level, falls to a certain level, or if the underlying reason for owning the investment changes. Then, when one of those conditions is met, you follow the rule instead of creating a new emotional judgment on the spot. This structure matters because stress tends to narrow our thinking. Under pressure, people either freeze, panic, or rationalize. A written exit strategy provides a path through that stress. It turns uncertainty into a process. At a basic level, many exit plans use two core levels. One is a stop loss, which defines the point where you will exit to limit further damage if the investment moves against you. The other is a take profit level, which defines the point where you will capture gains rather than hoping indefinitely for more. For example, you might buy at 100, set a stop loss at 90, and a take profit at 115. These levels do not predict the future. They simply establish your response in advance. The value of the plan is not perfection. Exit plans are especially useful because real money intensifies emotion. Fear can push investors to sell too quickly during declines. Denial can make them delay accepting losses. Greed can tempt them to hold winners too long, hoping for just a little more. And loss aversion makes any sell decision emotionally heavier than it might appear on paper. A written plan helps counter all of these forces by giving you something objective to rely on. When your emotions argue for a different choice, the plan reminds you what your calmer self already decided. Selling quickly is not always panic selling.
Sometimes a fast sale is exactly the disciplined action your plan called for. The difference lies in the reason behind the decision. A disciplined exit follows a rule that was written in advance, such as a stop loss being triggered or a thesis breaking. Panic selling, by contrast, is a rushed reaction to fear, headlines, or market noise in the moment. From the outside, both actions may look similar because both involve selling. But from the inside, one is structured and intentional, while the other is emotional and reactive. In investing, the process behind the move matters as much as the move itself. A useful exit plan should be simple enough that you will actually follow it. Start with your buy price, because that creates the reference point for the rest of the plan. Then choose a stop-loss level that reflects how much downside you are willing to accept, and a take-profit level that reflects when you would be satisfied locking in gains. Write the full plan down, including the numbers and the reason for owning the investment. Just as important, decide under what circumstances the plan could change, such as a major shift in the company's outlook. Specificity makes the plan actionable, and simplicity makes it usable. Maria's example shows what this looks like in practice. She buys 100 shares of Greenleaf Energy at $50 per share, investing $5,000. Before she buys, she decides on two clear exit points, a stop loss at 45 and a take profit at 60. That means she has already defined both her downside limit and her upside target. Most importantly, the rules are written before she owns the stock, when her judgment is less likely to be clouded by fear or greed. This does not guarantee a perfect outcome, but it gives Maria a disciplined framework for what happens next. Suppose Greenleaf falls to 45, and Maria sells according to plan. The loss is disappointing, but it stays controlled at $5 per share, or $500 total. If she had ignored the plan and held while the stock dropped to 38, her loss would have grown to $1,200. The stop loss did not prevent loss altogether, and that is an important point. No exit strategy can remove risk completely. What it can do is prevent a manageable setback from turning into a much larger one. In that sense, the value of the plan is damage control. Exit plans work best when they are realistic and complete. A stop loss set too close to the purchase price may trigger on normal day-to-day volatility rather than on a meaningful problem. Another mistake is changing the plan after buying, especially moving the stop lower just to avoid taking a loss. Investors also forget the take-profit side and end up planning only for downside, not for what they will do when things go well. And if the plan exists only in your head, it becomes much easier to bend under stress. A strong plan should cover both directions and be clear enough that you can actually follow it. Writing the plan down makes it much more useful. A simple format is enough. The investment name, your buy price, your stop loss price, your take profit price, and the reason for owning it, along with a review date. This creates a record of what you intended before emotions got involved. Later, if the price moves sharply, you are not relying on memory or mood. You can look at the written plan and see exactly what you said you would do. That also helps with learning, because you can review whether your rules were sensible after the fact. Good investing improves when decisions are visible, not vague. The main lesson is that an exit strategy is not about finding the perfect sell price. It is about building discipline into a part of investing that often becomes emotional and chaotic. By deciding in advance how you will respond to gains and losses, you reduce the odds that fear or greed will take control. Success should not be judged by whether every sale turns out to be perfect. It should be judged by whether your decisions consistently follow a thoughtful process. Plans will sometimes be early, and sometimes they will look imperfect in hindsight. But discipline beats emotional improvisation over the long run. And one tool that supports that discipline especially well is dollar cost averaging. Panic selling usually begins with the feeling of urgency. Prices fall, fear rises, and investors start to feel that they must do something immediately. In that emotional state, selling can seem like a way to regain control. But selling during a downturn often locks in a decline that might otherwise have remained temporary. A paper loss becomes a realized loss at the moment of sale. That is why discipline is hardest when markets drop. The challenge is not just understanding the math of investing, but building habits that keep fear from taking over. One helpful habit is dollar cost averaging, often called DCA. This means investing a fixed dollar amount on a regular schedule, regardless of what the market is doing. If you invest the same amount each month, you automatically buy more shares when prices are lower and fewer shares when prices are higher. That removes the need to guess the perfect moment to enter. Instead of making each contribution a market call, you turn it into a routine. The power of DCA is partly mathematical, but it is also strongly behavioral. It makes investing less dependent on mood. DCA reduces panic by lowering the pressure to time the market. Without a plan, every downturn can feel like a difficult test. Should I buy, wait, or get out? With a preset schedule, that question becomes much simpler. You invest according to routine rather than prediction. That can make declines easier to live through, because a falling market no longer means you must make a dramatic decision every time prices move. It simply means your next scheduled contribution may buy more shares. In that way, DCA supports calmer, steadier behavior. Lower prices are not pleasant to watch, but they can help investors who are still accumulating. If you are adding money regularly, a market drop means your next contribution buys more shares than before. Over time, that can lower your average cost per share. This is why downturns are not purely negative for someone in the building phase of investing. They can also create buying opportunities as long as the investment itself remains sound. The benefit is strongest when you are still contributing and have time on your side. Of course, this only helps if the investment later recovers or continues to justify ownership. Putting DCA into practice does not require a perfect schedule. What matters most is choosing an amount that fits your budget and a rhythm you can maintain, whether that is weekly, monthly, or another regular interval. The key is to invest the same amount each time and continue through normal volatility. That consistency is what allows average cost to build over time. If the plan is too aggressive for your finances, you are less likely to stick with it when markets get rough. Simple, affordable routines are usually more effective than complicated systems that depend on ideal conditions. In behavior as much as finance, sustainability matters. Mia's example shows how this works during a decline. She invests $300 each month in the same stock. In January, at $30 per share, she buys 10 shares. In February, when the price drops to $20, the same $300 buys 15 shares. In March, at $15, she buys 20 shares. And in April, with the price partly recovered to $25, she buys 12 shares. Notice what happened. As the price fell, her fixed contribution automatically bought more shares without requiring a stressful decision each month. The results of Mia's plan are revealing. Across 4 months, she invested a total of $1,200 and accumulated 57 shares. That puts her average cost at about $21.05 per share, which is well below her initial purchase price of $30. When the stock is later worth $25, her shares are worth $1,425, leaving her with a gain of $225.
The key point is not that every DCA plan produces a gain. It is that her fixed process kept her buying through the decline, instead of panic selling into it. Her discipline changed the outcome.
DCA is useful, but it has limits. It does not remove market risk, and it does not guarantee profit. If the investment is weak and keeps falling for good reasons, regular purchases can still lead to losses. DCA also requires steady cash flow, since the strategy depends on ongoing contributions. And in a market that rises steadily from the start, investing a lump sum earlier may outperform because more money is exposed to growth sooner. So DCA should not be treated as a magic formula. It is best understood as a tool for managing behavior and timing risk, not for eliminating uncertainty. There are also a few common mistakes to avoid when using DCA. One is stopping contributions during a drop, which removes the very feature that can make the strategy helpful. Another is continuing to buy without checking whether the investment itself still deserves your money. DCA works best with quality investments, not with blind loyalty to a weak asset. Investors also run into trouble when they choose a contribution level their budget cannot support, or when they treat DCA like a guaranteed win. And some people overthink the exact schedule when consistency matters more than precision. The goal is steady, thoughtful investing, not mechanical investing without judgment. The big takeaway is that dollar-cost averaging helps reduce panic by turning investing into a routine. You do not need perfect timing, and you do not have to interpret every market drop as a call to act emotionally. Lower prices can buy more shares, which can help during the accumulation phase. But the deepest benefit is behavioral. DCA encourages discipline when markets feel most uncomfortable. Risk still remains, and the strategy is not guaranteed to outperform. Used with realistic expectations, though, it can be a practical way to stay invested without